Thank you so much for giving me this time. And it's always a pleasure to get an opportunity to network, so I don't take this lightly. Thank you so much to the organizers and for all delegates who have attended. I think there's definitely power in networking, and I look forward to at least speaking to each one of you this afternoon. Now, my name is Samuel Chinya, and as already mentioned, I'm here on behalf of Blue Hectare. Now, Blue Hectare is an accounting firm that specializes within the health and social care space. It's always a challenge when you are given the stage or the mic to present, because I think you start to wonder what topic or what message can I deliver. And for those who know me, they know that I like to get help from the room. So today, I think we are all going to help me present on understanding your financial statements. And rightly so, these are essentially the accounts that you prepare for company's house. Your profit and loss statement and your balance sheet, which hopefully those are terms that you're familiar with, right? Come on guys, remember, I like the room, guys. It's tough being here, especially if you don't help me, then I feel like I should sit down. So we need to walk this journey together. Now, before we dive into financial statements, in terms of our services, what we offer, so effectively, like I said at the start, we specialize within the health and social care sector. And what we actually have done is we have kind of pivoted our service. We now offer what we call a virtual finance office. Put simply, we understand that most of you guys, when your businesses are growing, as you set up your companies, you need certain aspects of a finance team. So you need a finance accountant, you need someone who helps you with the invoices, accounts receivables, you need someone who helps you paying your purchases, accounts payables, you need someone who helps you with credit control, but you can't afford to hire these people because you're just starting up and your business is still growing. So what we have done is, for a fraction of the cost, we can extend all those services to your organization. So effectively, we become your virtual finance office, making sure that all your finance needs are catered for. What am I talking about? Your accounts submissions to company's house, your payroll service, your HMRC submissions, even your HMRC payments for those who have employees, VAT to those who it applies to, confirmation statement, management accounts, tendering, costings, statement of financial viability. I think someone spoke about it already. It's essentially all those functions that we'll offer to you. Now, we fully understand that what you need is bespoke. So even though this is what we offer, you're still able to pick and choose the service that you want without that portfolio. Now, without wasting much time, we'll jump straight into it. Are you guys aware of the company's house change regarding financial statements that is effective from the 1st of April 2027? So effectively from 2027 April, 1st of April, which is exactly, I think, 1 year, 9 months from now, you're only going to be able to submit accounts using a system, electronically filing accounts. No more paper filing of accounts. So gone are the days of those directors who say, I do not have an accounting system, or I do not know what system my accountant uses. That is becoming redundant. At best, you're left with 1 more year of reporting on spreadsheets before you move to a system. Now, the good thing is you can either do it voluntarily or you wait until the deadline, then you panic when you move. For us, I think this is a good move, and I welcome this change from company's house. The other one that I do not welcome so much is from the 1st of April 2027, you now have to report your full P&L on company's house. Your full profit and loss account on company's house.
Would that be public?
Yes. Everything on company's house is public. So your full P&L is going to be public from the 1st of April 2027 on company's house. To those who know, I can see your face is starting to drop. You're getting your accountants to squeeze in costs that are not business related. From the 1st of April, you can't get away with this. And essentially, this is why we're here, to effectively just help you understand what that is and what that impact is going to be for you. Effectively, what it means, Mr. Mshani, is I can now see your salary when I look in your accounts. No, I'm joking. I think with a huge team, you can't see anyone's salary. But you can see what a company is spending its money on. And I'll just share that importance for you as we go through. Now, why does this matter? Why does this change matter? And why should you be concerned about what's on your profit and loss account and balance sheet? It matters because it is your legal responsibility as the director. You are the one who sign off your accounts, right? Hello? Accountant prepares them, but you sign them off, right? Do we understand what we sign off? I'm guessing yeses and nos. Do we understand what we sign off? No. Honest answer. And the danger is, I might be your accountant this year. Come 5 years later, I'm no longer your accountant. You signed accounts and an investigation is opened regarding to the accounts that I did. Your new accountant didn't work on that. You didn't ask any questions. And now you are left, again, you are responsible for providing answers to that. So I think this is one area that, in as much as directors love CQC and Ofsted so much, again, for those who know me, knows I'm trying to fight with those guys to make sure that finance is respected to that same level. It is your responsibility to make sure that what you sign off, you fully understand, and you ask questions to your accountant. Now, I'm just going to be quickly taking you through the profit and loss account and the balance sheet, and effectively maybe just showing you what it means and what it is. Now, for those who know, a profit and loss account or income statement is essentially a statement that shows you the profit or loss of your business over a period of time. That's essentially what it is, put simply. It shows you whether you're in a profit or you're making a loss. Hopefully that is clear. Why do directors need to understand their P&L? As I mentioned already, it's your legal responsibility. You sign off that statement, it's your business, it is your legal responsibility. It also gives you financial control and sustainability. And last but not least, which I think lacks within the healthcare space, you can also use it to make strategic decisions that drive where you want to steer your business. You stop acting on a whim or what your other director wants, but you start to use the financial records, the financial data that you have to make business decisions. An undervalued tool which you have. What can a P&L tell you? It can tell you, again, are you operating at a profit or are you operating at a loss? It can also tell you which services are financially strong or underperforming. Now, what we tend to see is a lot of people may start off with dom care. As they start to make a bit of money, they diversify into supported living, children's homes. You're opening up different branches within the care sector, but you're all reporting for them under the same line, sales, turnover. You don't know how your domiciliary care business is performing. You don't know how your homes, children's homes, supported accommodation, supported living are performing. It's good to understand how each profit unit or how each business unit is performing so that you can help make better decisions for your business. And last but not least, one of my favorites, are you managing costs effectively? And from costs, yes, we mean even staff. Staff is a business cost. Are you just recruiting registered managers for the sake of registered managers? Or offering them too high salaries because they're hard to find, so you overcompensate on salary? Again, the quality, questionable. You guys might know better than I do on that. Now, hopefully you can see on the screen the 4 or 5 key items that I'm just going to touch on to, again, just help you understand on the P&L. So, for those who have seen this, which a lot of directors were standing up and I still remember you, you know this. This is almost a semi-abbreviated P&L. Again, what I'm just saying is it's a summarized one, not the full one that you would need to provide to company's house from the 1st of April. It will need to be in a bit more detail, but it will look something like this. And currently, it also looks something like this. And the key items that I just want to touch you on is income, which is effectively your revenue, your cost of goods sold or cost of services, the gross profit that you make, your overheads, and then your net income or net profit at a loss. Income, revenue, we all know what this is, right? Yes. What is it? You saw this coming. You knew I was going to ask, right? Come on. Your sales. Total invoices. I like that. I like that. Do you count cash when you look at income? Guys, remember we came to help each other today. Or maybe you missold your tickets. Do you count cash when you're looking at your income? When you're recognizing your revenue? Yes. That was a strong yes. So by cash, I mean whether invoices have been paid or not, the money that you've received. Do you count that under your income? Come on, guys, be bold and be confident. It's hard enough for me to be here. You guys, it's part of the money coming to the business. So when you're recording your income, you count your cash that you've received. Perfect. You can either do cash accounting or accrual. I can see a fellow accountant in there. To again down it down a bit, I'm going to say no. Yeah? Your income, your revenue is based on the sales invoices that you've issued, regardless of whether they've been paid or not. Yeah? I'll repeat that for those at the back who are quiet and confused. Your income refers to the sales invoices that you've issued, regardless of whether they've been paid or not. Exactly. I know what you're coming back to say. Yes. You raise your invoice, you record it as sales, right? It goes in. You deduct your expenses, you see a profit. On that profit number, you pay tax to the taxman, right? That invoice doesn't get paid. 2 months, 4 months, 8 months, 2 years, that invoice is outstanding. The taxman already wants his tax money and you've already paid it. And that invoice remains unpaid. What you do is you write that invoice off as a bad debt. Yeah? You have to write that invoice off as a bad debt. So effectively, you credit note that invoice. You're effectively saying, I had raised this invoice, nothing had been paid, so you're taking it out of your books. By taking it out, you get your tax money back. This is just, again, me simplifying it. But a lot of us don't do this. A lot of us overpay because we don't even know whether an invoice has been paid or not on our income. We have some private clients who have run away with our money. Some have unfortunately passed away. Some councils just forget to pay you on certain invoices. I still think it's deliberate, but who knows. And we don't write this off. And effectively, we're overstating our income. And again, it comes to affect the profit or the tax that you pay for your business. So I am happy that now, hopefully, if anything, we understand. Revenue based on invoices that we raise and send out, regardless of whether they've been paid or not. When we talk of the P&L, we don't talk of cash movement. We're effectively talking about sales invoices and purchase invoices. Again, really, really important. This is why a business can raise so many invoices, get 9 paid, and then they're in trouble. And I'm sure you've heard of the phrase, cash is king. Now, this is what effectively revenue is on our P&L. The next is essentially just cost of goods or cost of services. These are effectively direct costs that contributed to you getting that revenue that you got. Put simply, for us, most of us here, we're in the health and social care industry, we know that people are our number one resource, right? Staff. Correct? Yeah. So staff literally come and sit under our cost of service. We are providing staff and we're paying them in relation to the income that we're getting. I think the ratio for dom care is pretty much almost close to 1-to-1, because for every hour they work, you get paid and then you pay them, right? This is effectively what this is. Why is it important to understand this? It's important to understand what are the key costs that are impacted by you obtaining the revenue that you're getting, or effectively delivering the service that you're delivering. Again, another component that is overlooked by many. Gross profit, we're essentially saying your income less your cost of services is your gross profit. This is before you look at your other business overheads that have nothing to do with the care that you've delivered. This is straightforward, right? Sales, revenue, expenses, cost of goods sold, gross profit. What we tend to find here is when you undercut yourself and bid low for those tenders just to get your foot in, you're already making a loss by the time you get here. Yeah, because your revenue is so low that it doesn't even cover the cost of staff that you're sending to fulfill that package. You're running a loss here. This is even before you pay your wonderful accountants at Blue Hectare. You're already in a loss. Do you understand costings for the packages that you have? Again, question for you to ponder on. After your gross profit, we come to your overheads. Overheads, effectively here, what we're just talking about is we're talking about all the other expenses that are in relation to you running your business. So things like cleaning, accounting services, rent, insurance, all the other expenses, even the ones that you try to get your accountant to throw in when you go on holiday to Dubai with your family, and you're trying to tell him this is travel, and they're saying, no, I can't accept that. And you're saying, but I had a business conference, huh? You were there for 3 weeks, you only spoke for 1 day to receive your award, and you want it to be a business expense. This is the stuff that people are going to be able to see from the 1st of April 2027. Overheads. So effectively, everything comes up in overheads. When you're saying my tax is too high and you're not keeping your receipts well, your overheads are understated, again, it affects, again, the tax that you pay. So hopefully we get a good understanding of what overheads are. Last but not least, you then come to your net profit or loss. Effectively, when we look at your revenue, COGS, gross profit, overheads, are you in a profit or are you in a loss? If you're in a profit, we then have to pay tax to the taxman at 19% up to 25% sliding scale to HMRC, which is paid 9 months and 1 day after your company year end. Again, really, really good to make sure that your accounts are done on time, nice and early. And also, you don't need to wait until 9 months to know how much, until the year is over, to know roughly how much tax you're going to be paying. You need to be having these regular conversations with your accountant so that the tax bill is not a surprise. You're not caught unaware and you're thinking, but where's the money? Something we hear a lot, huh? I didn't even get this money. Are you sure this is the tax that I have to pay? Again, plan nicely. Understand this so that you see this. Now, the good thing about the P&L is it resets every year. So as soon as your financial year starts again, everything is wiped to zero. Then you start again. I am saying this so that at the back of our heads, we can keep this in mind. There are consequences to everything that we do. And I will show you some of them as we go on. Now, moving across to the balance sheet or statement of financial position. This is essentially a snapshot of your business financial position at a specific date. It's at a point in time. So you see this will be as at, it has to be at a point in time. And the reason why that is so that we can, one, verify most of the numbers that are in there at that particular time. Now, with our balance sheet, what do you need to understand when it comes to your balance sheet? Again, it's your legal responsibility to make sure that you understand this and that your company can pay off its debts. The balance sheet helps you spot problems early. It essentially gives you a better picture than the P&L. It also shows whether you're too dependent on debt or you're building value for your business. What can this tell you? It can tell you whether you have enough cash to cover your, to cover your bills, your short-term current liabilities, at risk of insolvency, and effectively, can you invest or are you able to expand, i.e. make those strategic businesses or decisions that you want to make. Unlike the P&L, we're only going to focus on 4 key items here, hopefully, as I get ready to conclude. So essentially, we're going to look at your fixed assets, current liabilities, shareholders' equity. If you buy a property in your name, it's not a business asset. Yeah? If you buy a car in your name, it's not a company car. Yes? I'll repeat that. If you buy a car in your name to reduce the tax that you're paying to HMRC, but you then register the car in your name and the contracts are in your name, that is not a business car. That is a personal car. Okay? So for an asset to belong to the business, it needs to be registered to the business. I'm sure you understand you and the business are 2 separate legal entities, right? Yes. Yeah. So again, one mistake we see quite a number of times when someone says, oh, we have these assets on our books, show us the paperwork. Nothing is registered in the business name. The business can't pay for that. It's not a business cost or a business expense. And most assets are not expenses. So be careful. When you're buying assets and you're thinking you're increasing your expenses, as most fixed assets are not expenses. Current assets. This one for me is a bit of a painful one because effectively when you speak of current assets, we're talking about what things do you have that can easily be turned into cash so that you can pay your debts. Number one, the cash that you have in the bank, the money that you have in the bank. It's already cash, so that's a current asset. Hopefully that makes sense. The second one is what we call trade debtors or trade receivables. These are effectively invoices that you have issued, but they have not yet been paid. So remember those invoices we spoke about when we talk about revenue? Trade receivables. This is why it's really important to make sure that when you raise an invoice and it's sent out, it's recorded in your accounting system. It comes and it sits here. It shows, again, the invoices that you can quickly turn into cash. essentially, because we know they're going to get paid before they become a bad debt. If they're bad debt, you need to have a policy within your organization, i.e., do you write off bad debts after 6 months, 1 year, or 2 years, so that we remove it from there. Because we can't overstate our trade receivables to say we're expecting to receive 200,000, but that money is not coming from anywhere, or we have never raised invoices for that sort. Hopefully that makes sense. Good, good. Now, when it comes to you guys, when you sign your accounts, this is one of the documents that hopefully your accountant gives in front of you. One of the things that you see there is your company bank account or company bank accounts, right? Yeah? Remember, balance sheet is at a point in time. It shows you what your bank balance is at your year-end date. If your year-end date is 31st of December, it will tell you your bank balance in your NatWest account was X. It's amazing how many accounts get submitted with an incorrect bank balance. I know it's painful because I'm almost asking you to redo your accountant's job here, but I'm asking you just to be diligent, to be vigilant, and to see whether they've just done the basics that they should do. Imagine your accountant files your accounts saying that you had 50,000 in your bank when you had £5. Yeah? Where did the £49,995 go? Where did you spend that money on? When I see that bank moving from 50,000 to £5 next month, I'm going to expect to see you buying something or transferring money somewhere, that money coming out of your bank, but you never had it. Now, we can't just erase that and say, oh, last year they made a mistake, this was supposed to be 5. No, it will come with an impact to your P&L, to the amount of tax you're going to pay. I'll repeat that. Anything that is incorrect here on your balance sheet will come back to your profit and loss account to correct your accounts. Unlike the P&L, the balance sheet does not reset every 12 months. It continues for the duration or the lifespan of your business. You build onto this year on year on year on year on year on year. Hopefully that makes sense. This is really, really important. Let's understand what we are signing. Let's ask those questions. It's painful to hear that some accountants don't even have meetings with their clients to sign off accounts. They just give you to sign, then they submit without explaining anything. Please stop doing that if you're doing that. Request a meeting with your accountant, have them explain what they have done, make sure you verify that which you can verify without redoing their job, because like I said, when you investigated and they've resigned, that falls back on you. Current liabilities. This is essentially, who do you owe money? So for those of you who are notorious about not paying HMRC for your PAYE, that balance should be sitting here. I'll repeat. You're thinking you made a profit last year, when in actual fact you made a loss. So this accountant made you pay tax to HMRC when you should not have paid tax. Yeah, you're making business decisions on a profit that was never there. Do you know how dangerous that is for your organization? It's expensive, someone said. If you miss early warning signs, again, have regular review meetings with your accountant, quarterly management accounts, half-year management accounts. Don't just speak to your accountant when accounts are going to be submitted. Now, you can't just turn up now after this, call your accountant and say, well, how come we're not having management accounts? Because I'm sure it's a service they charge for. And to you directors, I'm challenging you, invest in that service. It's a service worthwhile. It's a service worth investing in. Reputation and operational risk. If you are not looking after your business well, you sign things that you do not understand, it can even affect some of the councils and the contracts that you're working on. And I'm sure we understand this, right? Silence, I will take it this time because I too am tired. Financial instability. This is another danger of not understanding what you're signing off. Now, how can we help you? And as mentioned, we can help you make sense of your numbers. Put simply, accounting doesn't have to be jargony. It needs to come down to the level where you understand what you're doing and how your business is performing and effectively what you're signing off. We can make sure that you're compliant and we reduce the risk of your business. Now, I can't pay tax on your behalf, but I can tell you the dangers of not paying tax, and I'll warn you where you're heading with your business. That decision still lies with you, but at least I have made it known to you. We can also help improve profitability. It's amazing how many businesses have different offices in different locations when sometimes you don't even need them. You have just increased your expenses for the sake of expenses, and yet you're running a loss on something that could be profitable. Again, we can help you with this. Did you also know you can actually go to the council and say the package that we had is no longer profitable, and you request a percentage increase of your contracts? Did we know? No. Or we just wait for the annual inflation number where they give you 2%, inflation was 5%, and you're thinking, how is this making sense? You can, but you need evidence before you go there. You can't just go and say, I need more money because I'm not profitable, yet you're abusing expenses. You need to make sure your numbers make sense, you have done the work, then you can approach them. And sometimes they do listen. Sometimes they do listen. Again, strategic advice for growth. It's things that we can offer to you. I do apologize for taking a bit more time, but thank you so much, ladies and gentlemen. Please do give us a follow on LinkedIn, Facebook.